The Quarter on Wall Street, a look at Charles Schwab. This is where we dive deep into the financial pulse of one of the most influential brokerage firms in the industry. Earnings season is always a whirlwind on Wall Street. Companies rip off the Band-Aid, revealing their financial health to the world. It's a time of high stakes and intense scrutiny. This quarter, all eyes were on Charles Schwab, the discount brokerage giant. Known for its customer-centric approach and competitive pricing, Schwab has always been a key player. Investors wanted to see how the company was navigating the current economic climate. With market volatility and economic uncertainty, the stakes were higher than ever. Remember, Schwab makes money from fees and interest income. Both are under pressure in this environment. The fluctuating interest rates and market conditions have made it challenging. Schwab's second quarter results were a mixed bag. The company beat earnings estimates, which is always a good sign. However, the details reveal a more complex picture. But there were some yellow flags waving too. We need to pay attention to those. These indicators could signal potential challenges ahead. That's what we'll do right here, right now. We'll break down the numbers, analyze the trends, and see what the future might hold for Charles Schwab. One of the biggest concerns was the slowdown in client inflows. Fewer people are opening new accounts with Schwab. That's a big deal. Schwab needs new clients to grow revenue. The company blamed the slowdown on market volatility and economic uncertainty. Hey, that's impacting everyone, right? Another worry? Deposit outflows. Customers are pulling money out of their Schwab accounts. Why? Because they can get better returns elsewhere. Think money market funds or even just plain old savings accounts. This is a double whammy for Schwab. It means less money for them to invest and potentially less revenue. The Federal Reserve has been aggressively raising interest rates to fight inflation, a move that has significant implications for various sectors of the economy. That's been good news for banks, who are making more money on loans due to the higher interest rates. They benefit from the increased margins on the loans they issue. But it's been a headwind for Schwab. Why? Because higher rates make it more expensive for Schwab to borrow money, which is a crucial part of their business model. This increased cost of borrowing eats into their profits, making it harder for them to maintain their earnings. That eats into their profits, reducing the overall profitability of the company. Looking ahead, Schwab's earnings growth is going to depend, in part, on what happens with interest rates. The future of their financial performance is closely tied to these economic indicators. If the Fed cuts rates, Schwab's earnings should get a boost, as lower borrowing costs would improve their profit margins. But if rates stay high or even go higher, it's going to be tough for Schwab to grow its bottom line. The company will face ongoing challenges in maintaining profitability under such conditions. Section 4. Buyback halt, a strategic shift. In a move that surprised some investors, Schwab announced it was halting its share buyback program. This decision came as a shock to many who had been closely following the company's financial strategies. Share buybacks are when a company uses its own cash to buy back its own stock. This practice is often seen as a way to signal confidence in the company's future prospects. It's a way to return capital to shareholders and boost earnings per share. By reducing the number of shares outstanding, each remaining share represents a larger piece of the company's earnings. So, why did Schwab hit the pause button? What could be the underlying reasons for this unexpected move? The company said it wants to conserve capital in the current economic environment. That makes sense. In times of economic uncertainty, having a robust cash reserve can be a crucial buffer. With all the uncertainty out there, it's probably a good idea for Schwab to have some extra cash on hand. This could help them navigate through potential financial storms and seize new opportunities as they arise. But it's still a blow to investors who were counting on those buybacks. Many had anticipated the buybacks to continue, providing a steady return on their investments. Section 5. Market reaction and investor sentiment. So how did the market react to Schwab's second quarter results? The stock initially sold off on the news. Investors were clearly disappointed by the slowdown in client inflows and the buyback halt, but the stock has since recovered some of its losses. The current sentiment around Schwab is cautious. Analysts acknowledge the challenges facing the company, but they also point to Schwab's strong brand and its history of navigating difficult markets. The big question, can Schwab keep attracting new clients in this environment? We'll have to wait and see. Section 6. A note of caution for the future. Look, I get it, Schwab's stock is down from its highs. Some investors might be tempted to jump in and buy the dip. But I'm urging caution here. There are still a lot of uncertainties hanging over Schwab. The economic outlook is murky. Inflation is still stubbornly high. The Fed could raise interest rates even further. Any of these factors could hurt Schwab's business. So while Schwab is a great company, I'm not pounding the table on the stock right now.